Hello, everybody. This is Christian Thwaites of Brown Janikowski. Welcome to our final call-in for the year 2019. And today we'll be using the same format. We'll be talking about 10 or 15 minutes, and we'll have questions open at any time. Feel free to type in the questions on the panel on the right-hand side. We'll be able to read those as they come through in real time. So any questions, just please throw them up if anything's not clear. And so what we're going to cover today is a little bit of some summary of 2019 and kind of look ahead for 2020. So let's kick right off. We've got some slides coming up. Hopefully they'll be useful for people, and they're showing up on your screen right now. So 2019, boy, what a difference 12 months makes. A year ago, we were just about to hit the bottom of the S&P for the year on December the 23rd. It was down almost 20% from its peaks in September. Things were not good. The trade outlook looked very worrisome. The Fed had made it clear that they were going to impose the fourth of their four hikes in 2018. And we had the kind of normal concern about we were going into a rising rate environment and a slowing economy. And then the big catalyst, of course, in January of this year, 2019, was that the Fed came out almost within the third week of January and said that they would be on hold, so that the four cuts that they made in 2018 would be held at that level. And so that immediately gave confidence at the market that the Fed wasn't just going to hold to a series of increases regardless of what was going on in the economy. I mean, the Fed had always said they were data dependent, but some of their actions, as I think Chairman Powell was sort of getting used to what it meant to be chairman of the Federal Reserve, the concerns were that they were just going to keep on hiking through following the dot plots from a year ago. But in 2019, they moderated that, and then they started a cutting cycle in the spring and ended that back in September. So 3 out of 4 of the Fed funds increases of 25 basis points were reversed in 2019. And so now we've got a very easy monetary policy. Fed funds hovering around about 150, 175, down from 225 a year ago. And more importantly, the Fed's outlook is for a slower economy, slower inflation, no change in unemployment, and a continuation of this easy monetary policy. I wrote in the blog last week that I think out of the 60 members of the Federal Open Market Committee, not all of which vote, but it gives an indication of who's saying what around the table. I think only 4 of them, I think 12 out of 16 of them expected rate increases throughout 2019, and now I think only 1 person sees any change at all in 2020. So that really does show that we're sort of in a period of stable rates, therefore stable bonds, therefore in a pretty stable, easy monetary policy. And then the Fed voting members change next month. In part of our blog about how that changes the complexion of the voting structure a little bit, but the bottom line is that the Fed gets a little bit more dovish in 2020, given the track record of its voting members, than it was in 2019. So that was the sort of big story in 2019. Of course, the constant backdrop week in, week out was the trade story, particularly with China, although it was being sort of fought on 3 fronts. You know, a lot of noise going on with the Europeans, although no actual triggers pulled except towards the end of the year in retaliation for the French digital sales tax and for the retaliation on the Airbus subsidy decision by the WTO. So Europe has got some tariffs set up against it. China obviously is the big one, where it's a much bigger trade balance, and there was much heftier tariffs, a much broader base of goods. But as we've just found out, the latest phase 1 deal seems to call a truce under that. For those of you interested, and I'll write about it this week, the US Trade Representative has a 2-page tear sheet on the terms of the agreement last week. I think it's very difficult for China to be able to follow through on its promises. But I think at this point, it's not really about details and holding anybody accountable. It's about having a top line, something to say as a success. And that's what we've got. And that's what the market was looking for. And also the other big trade story was on the third front, was kind of the US and Mexico and China, the kind of retweaking of NAFTA, which just shows how long it takes to get through that, because that was agreed over a year ago. It still hasn't hit the Senate. And then also what's going on in the economy was kind of a slowdown from the pullback from the tax highs coming through from 2018. So slower economy, slower Fed funds rate, and that really made it good for valuation of equities and people thinking that the economy wasn't going to go into slowdown. And actually, it's right here in this first chart. You can see the GDP. Forget about the GDI one. That's just an alternative measure of GDP that we track. But you can see over on the right-hand side, the bars gradually going down. Right out of the gate in 2018 was that 3.5%, I think, just over 3.5% print for GDP, and since then it's kind of come ratcheting down. And the consumer is still doing well, and pretty much anything else with the economy is doing less well. Not badly, but just less well. So that's manufacturing, big investment, and especially anything to do with non-residential investments. So that could be, anything from commercial real estate through to factories and output, and sort of anything which is to do with the producing goods economy. The government sector, exports, imports, were also doing not as well, but slightly lower negative numbers. But this was still enough with the consumer to keep the GDP going at about 2%. The next slide just shows what the S&P did, and there we go. My gosh, that last column on the right-hand side, 27% after last year's -6. I put in a long backdrop here just to show that, in the 10 years since the Great Crash, we've had some very good annual returns. We've only had 3 negative annual returns, and 2 of them were, only about 1%. So the biggest drawdown on an annualized basis was last year, where it was about 5%. There have been bigger drawdowns, but they just didn't happen to coincide with a calendar year end. But you can see other returns are 23, 13, 13, 30. So basically, if you'd stuck in the S&P, you've made about 250% since the crash. The numbers are a lot less impressive if you kind of go back to 1999, but this has been, a good turnaround in the teens years, from the prior decade, which were really struggling. Obviously, ended up with one of the worst crashes on record. But so we're obviously hoping that we'll finish out the year with those sort of gains. One of the questions we get a lot is the market expensive? And boy, there are so many ways to answer this. We look at earnings yields, which is the reciprocal of the price earnings ratio. We look at future earnings, just looking at price EBITDA and so on. But I think this one is as good as any, and it basically just shows that this is the number of hours worked required to by one unit of the S&P 500. The S&P 500 is around about 3,100 today. The average weekly wage is about 20. So you have to work about 151 hours to be able to buy one unit. And so there it is, quite high by historical standards, and sloping upwards when we use the moving average numbers as well. So that's not the greatest sign, but that might be as much about the low growth in earnings, and the average of hourly earnings, as many of you know, have been reading the blog, have not been moving very much in the last 10 or 15 years. So as I've been saying for a while, the market is not super expensive, but certainly no bargain basement either. And we think it'll continue to trade at these types of levels and these types of valuations, but it's not a point where we were last December, where we thought the market was very cheap after its correction. There is one big thing, which is the next slide, which is the federal deficit. This is not good. You can see that this is basically the federal deficit, which is that number at the bottom, 6.4% of GDP. And then we've just shown it against unemployment on an inverted scale. Normally those should run in line with each other. So the federal deficit should come down as unemployment comes down. And most of the time those lines do coincide with each other. Occasionally they kind of split off in different directions, like in the late 80s. But boy, this is the biggest one we've ever seen, which is record low unemployment, and not record deficits, but certainly moving in the wrong direction. This hasn't impacted markets at all yet. Most people are pretty complacent about this, and I think they're maybe not okay to be complacent, but they're okay not to be, overly distressed by it. The US has a lot of borrowing capacity, and the rates are pretty low across the board. But this is one area which I think will get more attention in 2020 and going forward. The next page is just what we've seen in treasuries. And again, a gangbuster year for the bond market, particularly treasuries. And this is intermediate treasuries. These are like, 5-year treasuries. If you've been in the 10-year treasury or the 30-year treasury, the numbers were considerably bigger than that. But you could see at the bottom, we were motoring along at total returns of treasuries of about 2, 1.2, 1.4, and so on, basically in line with the coupons of intermediate treasuries at the time. And then suddenly we have this big number, 5.2%, which is a lot, as I said, in the intermediate treasury world. And it is quite an outlier, especially for the last 10 years. So one of our cautions is that bonds have had a fantastic year. I think our bond portfolio is up more about 9 and 10% because we have credit in it. We have some slightly longer duration, but we would sort of caution that we would expect slightly lower returns from bonds in 2020. Not negative. We don't think rates are going to move very much, but certainly for the intermediate treasury area, we think returns of about 2 would be more in line with our expectations and more in line with the averages over the last 10 years. Just turning to the economy, the next slide is what we have been getting a lot of headlines recently. This is the ISM manufacturing. This is just a survey of major manufacturing companies in the economy. Just as a note, manufacturing is about 12% of US GDP, about 10% of employment. So, but it gets a lot more attention than the service side of the economy because there's a big multiplier effect. Jobs tend to be good and stable and well paid in the manufacturing sector, and it can be a real bellwether on as to what's happening with confidence generally. And as you can see, all those lines on the right-hand side took quite a tumble in 2018, 2019. This is manufacturing for new orders, new export orders, inventories. And you'd expect, given what's going on with the trade side, if you're in the exporting manufacturing goods and you're looking at countries taking retaliatory measures against the US import tariffs, that's not a good time to be trying to export your manufacturing goods to anywhere, particularly if it's going to China, the EU, or even Mexico and Canada. So orders, quite a big hit. And then if you're not getting the orders, you're still sitting a lot of inventories. So the inventory start to build up, and then your overall new orders goes down as well. So that's been what's really worried the market. And every time this has happened, the bond market has reacted quite well because they feel, well, the Fed's looking at these numbers too, and they're not likely to hike rates in an environment where these types of orders and inventories are heading down. From our perspective, we kind of think this will bottom out. It probably has already bottomed out. These are the numbers from October printed in November. And we expect the new numbers for November in the next week or so. They might be marginally better because they can be affected by the stock market, but generally that we think this will start bottoming out on the orders and inventory side. And then, so looking ahead to 2020, so the net result was weak economy in the manufacturing side, overshadowed by the trade, easy monetary policy, stocks coming back strongly, bonds following as well. Actually, it might have been the other way around. I think the stocks following the bonds, but definitely sort of enjoying a slightly easier monetary environment. So what do we expect in 2020? Let's just start with the big one, which is the economy, which is, no, we do not see a recession. As we're trying to point out along the way, this has not been a stellar economic recovery from 2008. Even with today's housing numbers being, at a post-cycle high, they're still 30–40% below their peak in 2007. So it's still large parts of the economy which are not near what they achieved 10 years ago. In other words, recovery has been weak. generally, and you can see that in wages and employment, slow pickup in labor participation, and general feeling that the economy is doing okay, but it's not ripping to the upside. So therefore, weak recovery, weak recessions, kind of how we view it. There might be a quarter or two where it lapses into a 0% return, especially if there's a big trade problem. But don't see any sort of big parts of the economy as being vulnerable, and it's the same overseas as well. So even though world trade has taken quite a big hit in 2019, on the stock side, I mean, we're going to stick with a fairly middle of the road forecast that we think 7 or 8%. That would mean really no change in valuations. I mean, stocks are essentially driven by only three things: how much investors are willing to pay for stocks, so that's the multiple; how much companies pay out in dividends and/or share purchases, and how much they can actually grow their underlying earnings. And so we think the growth is fairly modest, 2%. Dividends and share buybacks is about another 3 to 4%, and maybe a modest revaluation kind of gets us to the 7-8%, which is, by the way, the number that we use 7% as our estimate for stock returns for financial planning purposes. And we could say that maybe that number will come back, primarily because energy and healthcare have been under such a cloud in 2019. They have not participated in the market at all, and they're likely to come back a little bit just because they've been so hit so hard in 2019. So it only needs two fairly important sectors. Energy is important from an earnings point of view, not from a market cap weighting point of view, and healthcare obviously hugely important in the index to come back a modest bit, and we should be able to see those kind of returns. Obviously, politics, whether it's election or impeachment or something else we haven't spotted yet, could come along and hurt things. But generally, the consumer is doing okay, relatively confident. Unemployment rate incredibly low. Hours worked not really moving very much, but certainly not being cut. Wages again not moving very much. Nominal increases of about 2 to 3% on a good day. Real increases of about 1.5–2%, pretty much in line with what they've been for the last 20 years. And then on the bond side, again, we'd sort of come back to this range of 1.8 to 2.1. The Fed is obviously not going to move for quite a while. Don't see any other central banks moving. And I think everything takes its cue from the 10-year Treasury, spreads and everything else. So I think our estimate for the Treasuries would be about 1.8 to 2% total return, and for bonds maybe 3 to 4%, basically implying a slightly unchanged credit spread of about 1 to 2%. So a good summary, good 2019, obviously feeling a lot better this December than we were this time last year. There could be a fair number of headwinds still, but I think we're relatively well set up for 2020, and we certainly don't see the more sort of cataclysmic scenarios coming through, despite things like the deficit, despite what looks like very discordant politics here and overseas. Businesses, I think, are in relatively good position. They're not overly stretched financially. They're certainly not facing any wage pressure to either hire more people or pay them much more. So I think a lot of that will just continue to stay the same. So a cautious optimism as always going into 2020. So I'm going to stop there for a second and just see if there's any questions. It doesn't seem to be at the moment, but happy to take any if people want to write them out. This call will be also available, we'll put up on the website, and so that feeds through to SoundCloud and a podcast if we're interested in doing that. And again, it doesn't look like we're getting any open questions. Either that, I've either bored everyone to death or explained things to incredibly lucid detail. I suspect I hope it's a bit of both. But if you do have any questions, please feel free to call me direct or your financial advisor, and be happy to come back to you, and we'll be writing up some of this in the blog. Okay, I am just going to read the disclosure now. So I know this is the point that everyone waits for. Please note the information provided in this presentation is for general information purposes only, should not be considered individualized recommendation or personalized investment advice. Investment strategy discussed in this presentation may not be suitable for everyone. Each investor needs to review an investment strategy for his or her own particular situation before making any investment decision. All expressions of opinion are subject to change without notice in reaction to shifting market or economic conditions. Past performance is no guarantee of future results. The opinions presented cannot be used as an indicator of future performance. And I wish everyone a happy holidays and happy new year.